Thanks very much for joining us. I'm Ollie Hesketh. I run NMG's Australian office, and I'm taking the opportunity today while Hamish Worsely is swinging through Sydney. Hamish runs our global asset management study, and I thought I'd ask him a few questions, having just completed the third year of the study, to get some of the insights. Thanks, Ham. So I think there were some particularly interesting things on the institutional asset allocations that came out this year.
Yeah, we found that one of the common challenges for institutional investors is getting returns in the low interest rate environment. And in many countries, this is exacerbated by the regulatory requirements that around solvency and capital that restrict insurers and pension funds from moving away from existing asset allocations. This is, making institutional asset owners look for solutions from their asset managers and also invest direct.
Right, so I guess alternatives play a bigger role in portfolios with that context. Is that fair?
Yeah, across the global study, we interview 500 institutional investors, and the feedback from those investors is or a willingness to increase their allocations to alternatives. And also global equities, emerging market equities and emerging market debt, and probably reduce allocations to domestic equities and domestic fixed interest. The challenges of that are there are constraints around regulation, and also finding alternatives that meet their long-term requirements and investment objectives.
Okay, so I continue on with that string about regulation, but flipping over to retail now. Obviously, there's been quite a bit of regulatory tightening globally in terms of retail advice. How are you seeing the advice models change around the world as a result of that?
Yeah, Ollie, I mean, we've both worked in the UK and Australia, where we've seen advice regulation have a pretty significant impact on advice models. And we're starting to see the same trends play through in the US and also in Europe. The US, it's driven by the DOL fiduciary rules, and in Europe, MiFID II regulations are having a big impact, as we've seen under, say, the UK Retail Distribution Review. Some of the big trends are, we're finding that advisors are focusing more on price value, in a world of greater transparency and disclosure. And this is forcing advisors to review their investment propositions and their client focus. And we're finding that while they're not giving up control of fund choice and fund selection for their clients, they're typically moving away from, long lists and consolidating the asset management partners that they deal with, and also segmenting their clients and delivering separate propositions to different client tiers that make sense from a cost value perspective. So overall, this is having, big impact on the investment solutions that are going to retail clients, and also on the asset managers' propositions to those retail advisors.
Okay, that's really, really interesting. On the asset managers, because I know we'll have some asset managers watching as well, and I know you track the brands of the asset managers globally through the study, I think across 14 different countries. What are you seeing change there?
So across our study, one of the key metrics is a brand ranking, if you like. And we do that separately for institutional and retail. Yep. One of the underlying reasons we do that is the evidence suggests that brand is important. So managers that have developed a brand profile and brand awareness attain greater penetration and share a wallet based on the study.
Okay, that's great. Thanks very much for taking the time. It was glad we could catch you while you were in Sydney, and thank you for joining us.